There are so few areas of U.S. public policy that won't have some implication for Canadian assets and for Canadian investors that it's worth taking a deep dive into what this U.S. election result and the election of a Republican president might mean for investors here in Canada. If you look at how markets reacted in the lead up to this election and with the resolution of a Trump victory, we saw that this was generally positive for equities, but particularly U.S. equities. We've seen stocks rally in the U.S. in the hope of a lighter regulatory hand, for example, and perhaps in the hopes of some corporate tax reductions or at least lower corporate tax rates than under the Democrats. But we've also seen bond yields move up, so bond prices have been falling. Long-term interest rates have been pushed up by concerns about future budget deficits being higher with tax cuts coming, and therefore more borrowing from the U.S. Treasury and some upward pressure on yields. Around the world, there have been other equity markets where we've seen some negative impacts on the fear of trade barriers. So a bit of a mixed reaction overall if we look from a global perspective. Ironically, because even though there are so many policy levers that could potentially be pulled one way or another as a result of this election, our forecasts for economic growth really aren't that much changed because we're at the stage of the business cycle in both the US and Canada where inflation has been coming down, and the job of central banks is to deliver enough interest rate cuts to accelerate economic growth in Canada and get us back to full employment and prevent more of a slowdown in the US. If trade barriers go up and that ends up stalling Canadian economic growth and threatening our export sector, we'll need even more interest rate relief here in Canada to get that pickup in economic growth to a roughly 2% pace in the next couple of years. In the US, we do expect growth to slow to, again, a little over 2%. And we won't see as many interest rate cuts in the US given their stronger starting point. The US equity market might face some challenges in moving a lot higher from here because we have seen a lot of positive sentiment built into where equity prices already are. And the reality is that the US economy is going to slow a bit from what we've been seeing, not only because we'll need that to keep inflation under control, but also because the Trump administration plans a dramatically lower pace of population growth, fewer immigrants coming in, and that actually lowers the speed limit for the US economy in the next couple of years. In Canada's case, it's a mixed picture for equities. There are certainly some sectors that could benefit from these policy changes. The US might, for example, be more amenable to oil imports, more interested in imports of uranium if they develop their nuclear energy, but also some concerns, at least overhanging Canadian export sectors in general from the threat of higher tariffs. We saw that really dent Canadian steel exports during Trump's first term. Whether those tariffs are going to come back across the economy as a whole, I think there's going to be some uncertainty and some hesitation, at least until we clarify whether Canada is able to negotiate an extension of our free trade deal with the US and Mexico. So some potentially bumpy roads ahead. We're hoping that deficits don't rise as much as markets are thinking in the US, that Congress insists on some spending reductions or spending restraint at least. Long-term interest rates, which moved up on the election result, could come down a little bit. Certainly here in Canada, we expect short-term interest rates to be coming down as the Bank of Canada delivers more relief to an economy that does need it right now. Given all the uncertainties we face over U.S. economic policy in the next couple of years, and the material implications that will have for our currency, our equity markets, our interest rates, a diversified portfolio makes sense in an uncertain world. And certainly this election and the wide array of policy changes that it could entail and makes the benefit of a diversified portfolio all that much more beneficial for the average investor.